Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. We are live at the Rule Symposium. I am here with Mr. Adrian Day. He has been in this space for a long time. I mean, just from me watching his interviews, hearing about his history, and just even him working in the gold markets and everything, it's amazing. Just to thank you for gracing us with your presence today.
Well, thank you for asking me, Darren.
Yes, indeed. So today the Fed raised rates.
Yeah.
So kind of what's your outlook on where we're at in the economy? And because ultimately I look at this as like, even though we talk a lot of macro on the channel, I mean, here we're focused on a lot of the micro details.
Right.
But you know, it's really the setup for why we need gold. You know?
Sure, absolutely. I was on the stage giving a talk when Powell was speaking, so I don't quite know what his nuances were, although I can guess. Yeah. But the way I'm looking at it is, the inflation numbers, you know, the CPI and PCE, which is what the Fed focuses on, are coming down. I think they'll probably continue to be soft for a couple of months. The Fed, I think we'll see another Fed rate hike before the end of the year after this one or even two. And the Fed dot plot shows us that that's what most Fed members expect. So we'll see higher rates and then they'll stop. We're very, very close to that stopping point, obviously. Whether it's another one or two almost doesn't matter. We're close to that stopping point, and they will take advantage of the inflation numbers coming down to stop. But I think that'll be a deceptive pause in inflation. You see what happens with oil in the last month? That all feeds through, but it takes a couple of months before it feeds through, because it's not just the price of oil. As we know, the price of energy is excluded from the indicator the Fed looks at. Yeah. Wonderful. Nobody eats or heats a house, according to the Fed. But the price of energy, of course, goes into transportation, and it goes into the price of every good we buy in the store, because they're all transported. And so, but that takes a couple of months before it feeds through. So by the end of the year, I think the Fed will have taken advantage of lower rates to stop raising rates, but inflation will be beginning to move back up precisely at the time when the economy is clearly moving into recession. We are moving inexorably towards a recession in my mind. It just takes time, and people sometimes forget that. And so what is that? That's persistent inflation and a slow economy. That's stagflation. And in the stagflation, the best performing assets historically and in other countries around the world, study after study has shown, best performing asset, gold stocks, commodity stocks. Mm-hmm. And the worst performing assets, obviously bonds, but also developed market equities, stocks.
All right, so where do you see interest rates going? Obviously, like a lot of people, they compare this to Volcker, you know, and interest rates went really high then. We have a massive amount of debt right now. Like, so how far do you see interest rates going?
That's an excellent point, because when Volcker came in, people forget, Fed funds rate was already in double digits, even when Volcker came in, but we didn't, and Volcker raised them to 20%. That's just simply not going to happen under Powell. It cannot happen under Powell because of, as you say, the federal government debt. You know, the debt at the federal government level, but also in the household and companies, but particularly the federal government, is just too high to jack rates up that much. I think we're very close to the end. It might be 5.5. It might be, you know, maybe they'll get to 6, which will be like a magic number, round number where they could stop. The danger is, you know, as Powell himself has said, higher for longer. So it's not a matter of continuing to increase. It's a matter of keeping them high for a long period of time. And again, things take longer to play out than we think. So everybody that has a auto loan, or every company that has, you know, a 2 or 3 year debt that matures and they have to roll it over, the longer you keep interest rates high, the more and more people are hurt. Yeah. So you can have a company, and as people and companies, you can have a company that maybe in 2020 termed out their debt for another 5 years. Mm-hmm. They've got 3% interest rate on their debt. It doesn't matter to them if rates go to 4, but once they have to renew that debt, then it matters a heck of a lot. Yeah. And every month that goes by, another household, another company is brought into that area where it hurts. So higher for longer is going to hurt the economy significantly.
Yeah, so I normally, like when you see the chart of when the Fed is raising, like you see the pause because like it tops out and goes straight for a little while, but then it goes down. And so when it goes down, is that the Fed cutting rates because of a recession or something on the horizon?
Well, for the last really for the last 30 or 40 years since Greenspan came in, it's only got worse. Bernanke was worse than Greenspan, Yellen was worse than Bernanke, and Powell was worse than, but for the last 40 years, they've cut rates either when the economy slows, unemployment moves up, or even when the stock market falls sharply. Now, Powell has said, and has evidence that he doesn't really care about the stock market. He'll let the stock market go down. But I think when unemployment starts to move up meaningfully, that will be a reason for them to either pause or cut rates. But the most significant thing will be if we have more financial problems, such as we did with the banks in March. And it's not just banks. Think of pension funds. Think of insurance companies. You know, they're hurt by higher rates and a slowing economy. So you get a major insurance company, say they're bankrupt, you can bet your bottom dollar the Fed will bail them out, just as they did with the banks. Mm-hmm. And so I think, the Fed will try to keep rates higher for longer, but inevitably, the more pain there is in the economy, the more they're going to buckle. We may not see interest rate cuts I don't think we'll see interest rate cuts for the first 6 months of next year. A lot of people are thinking they'll pivot and immediately cut them. I don't think that's where it's going to go. We may not even see cuts next year at all. But what I think we can be very sure of is that we are very, very close to the peak in rates. We're not going to 20. And that the next move in rates, 1 year from now, 2 years from now, will be to cut rates.
Mm-hmm. Yeah, that makes sense. So when the Fed does decide to cut rates, right now we have inflation, it's sticky, it's remaining around, and the Fed has been doing quantitative tightening, and as well as the Treasury refilling their general account. What does this look like for inflation when, our fiscal deficits, are still so high that has to be monetized somehow? If they turn the printing press, back on per se, does this lead to higher inflation?
Well, it does. I think the biggest impact will be shown in the fall in the dollar, the decline in the dollar, and the decline in the purchasing power of dollar, which will be reflected. The other side of a decline in the dollar is a rise in the price of gold, two sides of the same coin. I don't think the consumer prices will necessarily move up as much as some people are expecting, at least in the near term, because you have a slower economy that kind of partly offsets the impact of the printing. I mean, Powell, the Fed, has not come out and bluntly and said, we want a recession, we want more unemployment. They would never say that. But that's really what they want. They want to reduce aggregate demand. Reduce aggregate demand, that brings inflation down. And the way to reduce aggregate demand, obviously, is to put people out of work. Now, I'm not going to say that, but that's what they want. But how much do they want? Right now, you look at the unemployment rate, although it's ticked up a little bit. I mean, it's the lowest it's been in 40 years. But you look at what's called the U6, and the U6 index is published by the government. Not that I trust the government, but it's published by, this is not some fanciful thing. The U6 includes people who have part-time jobs, who want full-time jobs, who are looking for full-time, and it includes people who have stopped collecting unemployment but still want a job, right? So that's a better reflection of what unemployment is. Because to me, if you've got to work 3 part-time jobs just to feed the family, well, you're not unemployed, but you're not really fully employed. That number's 6.9%. So that's a lot different from the unemployment rate. Anyway, so let's say the unemployment, the U3, the headline unemployment rate, let's say moves up to 4, 5. I don't think the Fed will care. Moves up to 6, 7. I think they're going to begin to care. And the problem is not only is it unemployment, but look at, say, consumer spending. That's a perfect example of what's happening in the economy to me, and a perfect illustration of how monetary policy works with lags. Retail sales went up last year, and all the apologists said, well, look, the consumer's still strong. Look, the consumer's still spending. This year, it's gone up a little bit, but it's still up. But if prices have gone up 10% and consumer spending has gone up 4%, you and I are spending less, right? In terms of volume, which means we're buying store brand cereal instead of, Sugar Pops or whatever, and we're shopping at Walmart instead of at Nordstrom, etc. We're reducing the volume and the quality of what we buy, even though in terms of dollars, it's going up. Then what's the next thing that happens? The next thing that happens is, if you're a normal family, you try to keep feeding the kids and doing the same things you were doing. But you don't have the income coming in because prices are going up, so you reduce your savings. We've seen that. The savings rate has collapsed. The absolute level of savings has collapsed back to 20-year lows. What's the next thing you do once your savings are depleted? Credit cards. And again, we've seen credit card balances balloon upwards. And then what happens after that? Credit card companies, you start defaulting. You can't afford to pay the credit card because the average interest rate on credit cards is now up at 22%, which is a lot of money. And if you have a small balance or no balance, it doesn't really matter. But once that balance starts moving up, 22% interest makes it much more difficult to bring the balance down again. And so the next thing that happens is we get credit card defaults. Then suddenly one of the 2 people loses a job. And, they're in real serious hurt at that point.
Yeah, agreed. So,
But my point is it takes time. That process takes 2 years before it's evident in consumer bankruptcies.
That makes sense. So we had a banking crisis, earlier this year, and many people lacking confidence in the government and in their holdings and being insured. I would say people were fearful, right? And so, so what's the importance that gold plays in this? It's obviously money, right? And so, here at the Rule Symposium, we're talking about precious metals and resources and such, but gold has to play a big role in this because people don't feel like their money is safe,
Well, you've hit the nail on the head. I mean, gold itself, bullion, is not meant to be a speculation or a trade. It's a savings, it's a hedge. So someone this morning on the platform made a good point. I'm not telling you shouldn't be buying gold. You should be owning gold. And that's a different mindset. You own it as an insurance and as a hedge. And yes, obviously, the whole idea of insurance as a hedge is that one day you might need it. You hope you never do, but one day you might. But that's gold's role. And the more problems we have in the economy, whether they directly affect you and I or not, you and me or not, but the banking crisis, we have an insurance company go down. The more problems there are, the more people feel the need for insurance. So the more people will buy gold.
Yeah, agreed. Thank you, Adrian, for coming on
No,
today.
thank you.
Where can people find more about your work?
Well, thank you. The website is www.adriandayassetmanagement.com.
Okay. All right. I'll be sure to leave that link in the description.
Thank you.
Appreciate your time and coming on today.
Well, thank you very much.
Yes, indeed.
Appreciate it.